Yeah, Markus Beran. I'm in the industry since for more than 45 years. Currently, head of international investor department in Berlin Hip. We tap all the abroad money coming into Germany looking for finance, and we do that predominantly in Germany, but also we have an outlet in Amsterdam and Paris and in Warsaw, and there's other markets we are covering. Unfortunately, we don't have a presence in the UK yet. We were about to open that shortly before the Brexit, and now we have put that on the back burner and wait till all the regulatory issues are ironed out, and then take a new start from there.
That'll be about 20 years then, Markus.
You never know.
Christiane.
Thank you. I've joined PwC in January, and although I've joined PwC, I'm very sorry. I have to admit I'm still a lawyer, so I haven't become something more useful. As said, I have 10 years of experience. I started my career at DLA Piper. I'm focusing on real estate transactions and asset management work taking place in Germany. I'm heading the German real estate desk in London for PwC, and one of our focus is advising UK-based investors on their investments in Germany.
Great. Nikolai, and it would be good also just to reflect the sort of markets that you're looking in and the sectors you're looking in.
Sure, yeah. Nikolai Dëus, I'm principal and managing partner of NAS Invest. We have invested about 1 billion over the past years in German real estate across asset classes. Residential, retail, although we have sold retail just recently again, and mainly also office buildings.
Perfect. Thilo, it would be good just to get a sense of what the portfolio is there and what sectors you're focusing on. And I was also delighted to see that you've already introduced an element of competition between the UK and Germany in the worst performing cities. So that's good. Thilo.
For TH Real Estate, the total assets under management are around about 100 billion in the world, and the German end of that is around about 4.5 billion. And this AUM can be split in 4 different sectors. We have a big retail warehouse franchise, which is about 1 billion. We have a logistic franchise, which is also around 1 billion. Then we have shopping centers. It's a portfolio of only 3 dominant shopping centers in Berlin, Munich, and a smaller city called Erlangen near Nuremberg. So those are the 3 core components. And then we have office properties in existing shape in 2 partnerships. One, the biggest, is with the Swedish state funds AP1 and AP2. It's a fund called City Hold Office Partnership. And last but not least, we are running 2 outlet malls in Germany. One up in the north in Neumünster, between Hamburg and Kiel, and the other one at the outskirts of Berlin. So that's kind of portfolio that we have, and we are expanding on the quite rapidly on the logistics side. At the retail warehousing, we're buying and selling, and then the office side, we are in forward years also expanding the portfolio.
Great, thank you. Karsten.
Yeah, I'm Karsten Kohlmann from Waterway Investments. We founded Waterway Investments about 7 years ago to become a transaction manager with a focus on German non-core real estate. Since then, we've sold a lot of assets for the likes of servicing platforms, international private equity funds, etc. Branched out to become also a buy-side advisor, executing certain strategies in the German market, and we also provide capital solutions for German asset managers, investors that want capital partners from the international environment to invest in German real estate. So
okay, great. Audrey.
Great. So I'm with CoreState Capital. I'm their global head of fundraising for the institutional market, and I've got a network of investors worldwide. CoreState is a 22 billion euro real estate company and active in the DACH region. In addition to that, Spain, Benelux, and Hungary to a certain extent.
Okay, good. And given your limited time, let's focus a little bit on the capital side of it, because you know, as I mentioned, you've been travelling. What's your sense of what the capital, whether that's from the US, from Canada, whether that's from Asia, what are they looking at? How are they seeing Germany at the moment within a European context?
So I just got back from a 3-week trip in Asia and the Middle East. And I've been covering Asia for about 10 years, just traveling back and forth. And there's real interest in Europe for the first time, actually. I mean, by real interest, I mean people are actually deploying capital. So the Japanese, after doing 10 years of research, are moving forward, you know. And other parts of Asia have found themselves over-allocated to Asia and already sufficiently allocated to the US. And so they're putting a real emphasis on Europe, primarily Germany. Okay, Germany is seen as Thilo mentioned before, as the safe haven. And also to Thilo's point about how the Asian capital is certainly not anywhere near the majority of the capital. A lot of these groups are just coming in. I'm working with the Sovereign Wealth Fund that's putting their first amount ever in Germany right now, so from Asia. So you know, as far as like Asian saturation, in Germany it has a long way to go.
And in terms of, I mean, you mentioned there that they're looking at Germany as the first point. That's a change, I'm guessing, therefore, because historically it used to be that the UK was the first point and then people went into continental Europe. Are they seeing those as different pots now, or how is that? Or are they just hopping over the UK?
People are staying far away from the UK. You know, and it's not, this isn't surprising, you know, so investors don't like uncertainty. And right now, the UK is the hotbed of uncertainty. You know, and it's not only, you know, I had the chance to get into some, you know, kind of more in-depth discussions with investors in Asia and the Middle East. And basically, it's not only that they're waiting for the UK to sort itself out vis-a-vis Brexit, it's what happens after Brexit. You know, I mean, you'd be surprised how many investors actually knew who Jeremy Corbyn was. Scary. So.
He's very popular in those circles.
Right. So yes, they are largely. I mean, you know, you still have a lot of Hong Kong entities looking at the UK, but a lot of that has to do because of the, you know, very strong historical and relationship ties.
Okay, good. And Nikolai, just in terms of the types of capital coming to you, are you seeing a change? Are you seeing, as Audrey mentions there, are you seeing different types of capital? I mean, that's for everybody as well, but let's start with you, Nikolai.
Yeah, well, one has to say first that we traditionally actually have private capital in our investment structures, so stemming from Germany and Switzerland, but recently we have started working together also with partners from the Middle East and Asia, so we have also Chinese investors who are investing in our regulated fund products. Yeah, so there is demand, not only from the institutional side, but also from, I would say, semi-professionals like family offices, high net worth, ultra high net worth individuals.
Okay, good. And Karsten, what about from your perspective, because you're also sitting here in the UK, but looking at kind of joint venture capital and putting people together for the German market. What's your sense of that? Have you seen a shift in terms of the capital, either in what they're looking at or what they're looking for?
Well, I think there's definitely a wider spectrum of investors, right? I mean, we go to events like MIPIM, we don't meet the UK players, we don't meet the German players, we just look for the exotic players, right? So we meet Australian superannuation funds and Chinese private equity funds, and as Audrey said, I think there's a bit of a shift, because back in the day, like, they looked at London, then maybe Paris, and then the cycle already ended, and then they started all over again, and right now it's actually, there's especially demand for continental Europe with a focus on Germany from those players, and similar situation where players come out of Australia for the first time to focus on continental Europe and want to invest here. Obviously, there's still a road to travel, maybe another 12, 18 months, and we will see kind of what kind of assets they will invest in, what kind of partners they will pick for that, but that's definitely a positive trend. Yeah.
Okay, good. And Markus, we saw there in Thilo's presentation in terms of the growth prospects, the macroeconomy, all looking very positive. I mean, we've been doing lots of things about the growth that there is further east. And there was a lot of discussion yesterday in Bucharest about capital moving that way also. But what's your sense of the macro economy? Do you think that will just continue? Do you see growth continuing at those levels? Do you think there's enough to support that and thus support the kind of rental growth that Thilo was talking about?
Well, the rental growth, when you talk about Berlin, this is more driven out of scarcity rather than there's hardly any product. If you look for a bigger space in Berlin at the moment, you hardly get it. So there's a lot of development going on. Economy-wise, Germany has done well and is doing well, even whether we have in the government or whether we don't. It just seemed to work. People are eager, but from the real estate cycle, we are at I think very at the top of the cycle there. It's very expensive, it's very competitive. A lot of money is chasing product which is very few available, and that drives it a bit to the top, and that there's a bit of a scare factor that this might tip one day.
Okay, so you think there's if not a danger of a bubble at the moment, that there may be
a correction, not a bubble.
Okay, all right. Thilo, what's your sense of that? That wasn't in your doomsday scenario. I noticed that is there a danger of a bubble in any of these? Is it getting too toppy? Because that may also be one of the arguments why the UK is being overlooked, because actually, as well as the Brexit scenario, you'd also got late cycle in the UK as well. So how do you see that?
Well, we only see that there will be a bit of steam coming out of the pot, and a smaller correction, given the smaller interest rates. But for a bubble, you would need two factors. You would need too much of building activity, which doesn't have any sense. Like in Spain, those shopping centers that were built before the resi came, and the resi never came. That was a typical bubble cycle. But in Germany, you still have over demand and under supply in most markets. So so there's not apart from, let's say, some rural area where some mums and dads are buying, instead of renting, buying their private home. That's a personal problem because the interest rates are so low. But in the bigger cities, there's always over demand and over supply, so which doesn't indicate for a bubble. And I've just seen an interesting graph about lending and the lending volume. If you put that in comparison to the GDP in Germany, Germany is very low at the end of the table. And the second factor is, of course, the lending levels that are being put forward, and they are decreasing. So if you compare it between 2005 and 2018, there are almost no 100% lendings. The typical or the average lending level on the private basis is 79%, and on the commercial level it's much lower. It's between 50 and 60% where the Pfandbrief ends. So those factors, not oversupply and conservative lending practices, don't speak for a bubble. That won't happen. It's just a correction.
Well, also there are a lot of investors that are going into B and C cities. So, for example, in the retail sector, 85% of the volume went into B and C cities. 15% went into the A cities. So, and in the residential sector, the three cities that had the most investment, which is a little worrying, were Duisburg, Halle, and Straubing. So, I mean, you can make an argument for Halle and Straubing, but Duisburg.
Yeah. This is where I would normally invite the mayor of Duisburg to join us, Audrey. But we won't do that. And Audrey, one of the things when we were discussing this before, one of the things that you mentioned also was that the capital you were talking to, kind of debt strategies had moved higher up the list. What was the sense of that? Was that looking at kind of mezz strategies or senior debt, or was it a hunt for returns? What were they looking for?
Sure. So, this happens a lot when people feel like, the cycles are peaking. And I've had an overwhelming kind of sense of appetite for debt, mezz debt. So where people are trying to find the right price to risk comparison and trade-off.
Okay, because and the reason for mayors, I mean, maybe just pick this up with you, Markus, on the financing side. Is that because it's more difficult in terms of alternative investors in debt to be able to make decent returns from ordinary lending, senior lending? It's got to be mayors because otherwise it doesn't make sense, or why is that?
Yeah, it is competitive. The interest rates are at all-time low, so it's very difficult to make a good return, and the regulatory environment is more tricky than here in the UK. And most of that senior lending is based on the fund brief, and this has a rigid regime, which then most of the mezz lenders, they basically have no enforcement rights, and I think they have really to give up every position there to really call the loan, and then that's way different than you have it here. Because otherwise, if we would allow a kind of enforcement rights, we endanger this funding base. We need to increase the rating, risk-weighted assets under every loan, and then our lending becomes more expensive. So we only can hold those prices if these mezz pieces are treated as quasi-equity.
Okay, from your point of view, Christiane, is that move towards debt, is that because there's a position in the market where that's more of a defensive play?
We would say we are definitely late in the cycle, so people looking for more secure investment strategies. But in the preparation discussion, it was pretty interesting because we advised on several debt fund strategies. We're also looking at Germany's, but I understand it's a UK regime or a foreign regime. It's not a German regime. They're definitely looking at Germany, and I think they want to have the option. But I think you had a point on that, Thilo. You're saying it's not really possible in Germany or right.
I mean, you have a debt fund in the UK.
Yeah.
Yes, and one German investor who in there as well, but the potential for a debt fund, for a German debt fund, is very, very low because with the competitive margins, the returns wouldn't just be attractive enough for a debt fund. That's our experience, because we've got the team that we have here for the UK debt funds is a German-speaking team. So the first thing, if they saw a market, would be to jump on that, but it's just too low, and the returns of a UK debt fund can be between 5 and I think 6.5 or 6.25%, and for a German debt fund, I think the most that you could throw out is somewhere between 2 and 2.5%, which wouldn't make it worthwhile.
And one of the things, maybe picking this up with you, Nikolai, in terms of the retail side, I mean, we've got strong economy, we've got therefore growth, we should have more money in people's pockets, which should tend to suggest that retail should do better. So do you agree with Thilo in terms of that e-commerce is one of the risks for that, particularly in Germany? What's your sense of the retail market?
I think there's a clear distinction between, say, the top cities, the largest cities in the country, and then basically the regional centers. So in Germany, you have 20 million people living in the top 7 cities, but of 80 million, that's still 60 million. So those people live in smaller cities of 100, 200, 300,000 people across the country. And then basically the point is to what extent does e-commerce work? And so in the large cities, obviously there is large competition from e-commerce, but then if you go to the, I wouldn't call it the rural side, but to the smaller and the mid-sized cities, then definitely for e-commerce it's a challenge. And so for that reason, retail works, I think, in those markets, but one has to be very aware that I would say retail has moved up a little bit on the risk scale. And for that purpose, we have actually sold our retail portfolio. Not because it wasn't working, but simply because we thought the return compared to what we have on the risk scale is, not as favorable as it used to be.
Okay, so that's a change that you've made in your strategy because of that view. Okay, interesting. I'll take that to the ICSC conference next week in Barcelona. Just looking at and I've got a question come in on this as well, so thank you for that. Which is, interest rates have been one of the have appeared in a lot of the discussions that we've done lately, and especially in the outlook ones. So obviously increase in interest rates here in the UK, more likely to come. What's your sense of that? How much of a risk do you see that? And anybody can pick this up. How much do you see interest rates ticking up, and do you see that having an impact just in terms of what happens if interest rates do move up, and does that impact on yield? Does it potentially also impact on the types of investors who are looking? Anybody can pick up that slightly complex, difficult question.
The Eurozone interest rate is a political number. It is kept low for all the southern states, and that is to the benefit of all the northern countries, which should have actually higher interest rates. And that what is investment is fueled by all the liquidity streaming into that. To raise the interest rate would mean that all those countries who still are, well, they are slightly recovering, but if you raise it by 2%, all of a sudden they're back in trouble. So that's why they keep it politically low and try to sort out the issues. You see that with a joint European fund for bankrupt banks or whatever they try to establish, and it's a hard wrestling there to get it right. Who's paying for what? And there's not a clear. Well, there's certain interests which are colliding there, and as long as that is going on, I think the interest rate will be kept low, and the inflow will come to those countries like Germany, like the Nordics, and that will further fuel the investment pressure there.
And yeah, go ahead, Christiane.
Yeah, I totally agree. I think anybody expects the interest rates to go up at least a little bit, but right now we are talking about property yields between 3 to 5%, depending on the investment area of the asset class. And the last time we had these interest rates were in 2007, 2008. So, and I think, the question is, how much will they go up? And most likely there will be a gap between property yields and interest rates, which will make Germany and real estate still an attractive investment.
Okay, good. I just wanted to pick up one point as well. In terms of, you've got a situation where there's a lack of product. Seems to be one of the issues that keeps coming up, particularly with Germany, has done over the last sessions that we've done here for the last couple of years, difficulty with finding product. Does that mean we're going to have more development, and potentially does that then impact on some of the rental growth expectations that you've got in your slides there? Thilo, what's happening with development, do you think?
There's scarcity. The developers would be building much more, but the planning regime in Germany is still quite inefficient, and it takes a very long time. And especially picking out Berlin again, there you have a left-wing green government with a bit of socialist note, and you have different kind of regulating bodies for different districts of the city, and there are different districts where it's almost impossible to get a building permit, for example, for a supermarket, although the supermarket is desperately needed for the rising population in that borough, and even existing building permits are taken back, and this brings a scarcity in the product, and of course, in terms of saturation, Germany is quite far, and the supply of products is certainly there. But for new kind of concepts, some old concepts have to be torn down, or new concepts have to be put into place with more kind of affluence, more long-term stay potential, and those schemes, to get a permission for them, takes very, very long, and that puts a scarcity on the market and makes it hard for investors to find a product that they're comfortable to invest in, because if you have those old malls with a fashion component of, let's say, 30 to 40%, then you know that these fashion retailers who are the most under attack by the online retailers, they will go, and at least they will certainly decrease their space, and will be willing to pay less rent, and that's why there's a scarcity of product. You could build much more also on the resi side in many cities, but the regulatory body and the amount of people who are talking until you get a building permit, all the neighbors, all the different functions, and it's about insects that could be flying over that site at a certain point of time of the year. All those discussions are limiting the supply.
And then also it's the building cost, right? So not only because apparently there's too few firms who can actually cope with the construction demand, but then also from a regulatory perspective, construction costs have increased tremendously. So if you take, for example, the shift to renewable energies that's taking place in Germany and all the requirements that come along with construction, then actually building something below, I would say, 3,000 euros a square meter has become nearly impossible. So that in turn means that you need to achieve a rent, for example, in the office space of beyond 20-25 euros a square meter. And for that purpose, obviously in that, I would call it the top-notch segment, there's also limited demand. So it means that in the medium to, say, affordable sector, there is literally no competition coming to the market from the new developments.
Okay, and Karsten, in terms of, I mean, a lot of the ones that you're dealing with are sometimes ones where you've got to try and adjust it either back to core, or there's some value add work to be done on that. How much of that is then trying to change use potentially, or those kinds of things, and how helpful or otherwise are the cities within that? Is there a bit of a break on? Does that act as a bit of a break in terms of the ability to be able to change use and those kinds of things for the cities?
Well, I agree completely with what Thilo said, right? I think we see a lot of schemes, especially in B and C cities, where you have kind of department stores in good locations that are vacated or fairly tired, where like a new use would be kind of fantastic, but then you have the cities there which kind of make it a very risky place. So in a lot of those situations nothing happens, and investors or value-add investors we deal with kind of try to avoid those kind of investments, and over the last 12-18 months has probably escaped from investing in German direct real estate altogether and rather kind of prefer M&A plays, right? Where like you see Starwood now coming into CA Immo and Immofinanz, other players kind of for years by resi developers, etc., to try to pick up land banks and creative plays that way. But the proper direct real estate investment play, unless you're like a Blackstone who says, okay, we go long Berlin and we think rents will double over the next 5 years and we buy anything at any price, that's probably the exception there. But other than that, the proper value add players that need 15% plus direct real estate plays, I think, are gone, right? You need people on the ground in Germany, and you have a good example of people on the panel here like CORESTATE, NAS, TH, which kind of has a great team on the ground, and they can find the deals, can pursue closed-ended funds to find kind of difficult kind of assets. But the times are over where you sit in London and wait for kind of teasers coming in and say, oh, there's kind of already my 15% IRR kind of that I can rent up a bit of space and make money with it, or I just put it in the shelf and wait for a yield shift. I think that's definitely gone those times. So. And
Nikolai, in terms of that sense of it, is that also what you're seeing, that the market is much more difficult to find even those kinds of products? Where are you looking to be able to find the kind of products that produce the returns that your investors are looking for?
So for the past years, I would say we were seeking yield, like many others were also, and particularly we looked at a niche of 10 to 30 million deals, because those are, I would say, below the radar of the large institutionals. But also coming from basically a family background, those are the deals that you find, buying from semi-professionals, buying from entrepreneurs, buying from people who don't want anyone from London coming in and sitting across the table. So they would actually like to look in the mirror and see themselves. And so for that purpose, actually that's where you find the deals. But then obviously you have to have a network. You have to be on the ground. And yeah, so in that sense, our team in Berlin and Frankfurt works well together to basically go out and source those deals. And many times it's, going out for lunch, drinks, a beer, coffee, tea, whatever it is, meeting at events, not only in the real estate spectrum, so also in other places. And then suddenly, those deals come your way. But that's the work that you need to do, being there on the ground. Real estate is a local game, so it's, like Karsten said, definitely over to be able to do that from abroad.
Okay, good. And Thilo, I mean, in terms of that availability of product, we discussed it slightly earlier, but is it that there is no product available in kind of the core space, or is it really a pricing expectation issue that, yes, people are willing to sell, but not at a price that you'd be prepared to buy at?
Yes, people are there. There's a fair amount of product in the market, and there are also certain deals that don't go at a certain moment in time and then are picked up a year later. There are a few towers in Frankfurt that didn't trade last year and are now back on the market with a little bit half of a new lobby and 5% more price and something like that. So I'm doubtful whether this will go, at least for this price level. But in terms of ready product, like a baked chicken that is flying in your mouth, and the bidding competition is so fierce that you are not likely to perform or willing to perform. So that's why you have to go into relationships with developers, long-term relationships, and try to take a few more of the risks, whether it's a letting risk or a construction risk, rather not a planning risk, because there you are too far out in the water and too much can happen. But those risks you have to take in order to still get a decent return, because the yields in those bidding processes have gone down to 3%, and even with leverage and with all the costs, and of course you want to have a management fee as well. When you buy at 3%, it's mathematics that you can't distribute a 4%, which is kind of the magic number that institutional investors want to see out of real estate, a 4% distribution yield. You cannot get out of a 3% deal, and that's why you have to go in earlier. And for the UK, it's very, very well possible. Here the top yield is still 4.5, 4.75, but there you have to take the risk of the rental decline that might happen at a certain extent following when it's clear what result is coming. So in Germany you have the uplift of rents, the potential, but you have this very low yield level, and you can only play with that if you're going into forward deals.
And in Germany, probably most of the assets have been traded now in the last 3, 4, 5 years, right? And then you have obviously the broker universe where they still want to do their deals, and it's a lot of over-promising from what we heard going on, right? That you still promise somebody who bought or sold something 1-2 years ago that yields have gone further down, which they probably haven't, and then the Thilo scenario happens that deals don't trade and probably trade at 3-4 multiples less.
Very right. There's currently an auction going on with the tower in Frankfurt, and you still have it. You still have the memorandum somewhere in your files, and it once was traded only a few years ago for 175, and now the pricing is between 250 and 270, and then you really ask yourself, are you the stupid money now going in there? Yeah? And not really want to be that very often.
We experienced the same thing. We are not in the driver's seat, but it was in the back bench, and when transaction happened, come to us and look for loans. We have our valuation team doing the Verkehrswert, as you pointed out, and they hardly match the price anymore. The gap between the market price, which is the market value, and their valuation, the Verkehrswert, is widening. Not speaking about the fund brief value, that is completely out of discussion at the moment, but that gap, and I said, well, our value says we make the value, and the market has a price, and the market at the moment is ridiculous in the pricing. And
the Verkehrswert was the market value. You talk about it as the value.
The
Verkehrswert is the market value.
No,
it's hard to the Beleihungswert, which is below the market value.
No, the Beleihungswert is a legal value which is made for fund brief, for refinancing purposes only. It has nothing to do with what you sell it for, what you buy it for, whatever. The Verkehrswert our valuers do is something they do With comparables, yes, but it's never a market value with a willing seller and a willing buyer. So that is a complete different concept. So that's why a lot of banks...
So that's separated?
So you can easily have that we get the value of this tower for 175 and the purchase price is 220. Yeah, and so how do you close that gap? So we give 60 of our valuation or of the market price. Yeah, it's tricky at the moment. All banks are struggling with that if you have the mortgage bond refinance too.
But having said all that, there's definitely some volatility coming to the market. I mean, not necessarily from one side of Germany, but I mean, we all know we're late in the cycle, not only in Europe, also in other markets like in the US. So for that reason, there will be a correction at some point, very likely coming from outside the country. And obviously, this will also have an effect on Germany to some extent, although the fundamentals are good and they keep performing, in my view. But still, in Germany, you always find opportunities. It's a large country. You have many different markets, and it's very diverse. So from that perspective, we think that there's also going to be a value-add component coming up very soon.
Okay, interesting. I've got a question here from Oliver as well. Thank you, Oliver. Which is, so if it's not yields, too much debt or oversupply, what is the biggest risk for the market and what will end the cycle, since we've talked about where the cycle is? So what's the biggest, what would be the biggest cloud in your weather chart, Thilo, do you think?
Well, yeah, it is overpaying now and not having a long-term, or the strategy not enough long-term to overcome this pricing. Of course, we all don't want to sit on our hands and do nothing, and that's why we try to do sensible risk-taking in forward deals. But as I said, in the current pricing, just in bidding process with a completed product, in every sector, logistic is sub 5%. Logistic that always used to be 8%, sub 5% now. Resi is between 3 and 4%. Offices below 4%, and shopping centers. You always have this risk we were talking about. So it's maybe 4%, but this is
talking about core properties.
Yeah, core, very core property. That's why it is sensible, to do the forward deals, or to pick out existing product that is valued at or offered at a lower price because rents are or rental contracts are running out and so on. So this value at play can also be done, but.
Okay, good. And Karsten, I just wanted to finish off this point about the competitive nature of the market. Thilo mentioned that kind of 60% is domestic investors. Often, are you coming up against domestic investors or more international investors in terms of the competition for the sorts of deals that you're looking at? And do you adjust where you position yourself to be able to be kind of clear of the smaller domestic investors, private investors, and therefore also they're not in a gap there between competing with larger investors, international investors? How do you position that, and how are you seeing the competition?
Okay, international investors that come to Germany, they need a certain minimum deal size, right? So they probably only start with 30, 50 million equity checks, right? That already eliminates a lot of the secondary, tertiary cities, right? I mean, beauty of Germany is that you have 80 cities with 100,000 people plus, but in return, if you look at the office market, for example, you have a lot of cities where you have 8 to 12 euro rents, which means probably have low vacancies, but for a reason, because no development takes place and you have to buy a 100,000 square meter office building to kind of invest your equity in those buildings. Usually don't exist in those markets, right? So at the end of the day, you meet the same old players, right? If you go into the big cities, you compete with the German open-ended funds in the core universe, with the TH real estates that also represent obviously international money, etc. So to take those people by the hand and introduce them to the secondary, tertiary German cities is quite a challenge, I would say, because it's not a typical scheme that you see in other countries. You don't see it in the UK and France, etc. And then to educate them that Germany is like a federal system, and you have super strong cities with 200,000 inhabitants where you make a lot of money, and you have certain parties that ran those strategies or still do, like CORESTATE does, right? They decided to go into high street retail in those secondary cities, and they end up paying a couple of multiples less, but they still have the same tenants, covenants, and walls in their buildings, and probably a fairly decent future perspective there. But to come back to it all, to do that, you need people on the ground that are quite competent, right? And we don't. The main problem we see when we do our rounds in London is, A, people ask, do you have product? But B, do you have good operating partners in Germany? And there aren't many. There are a few good ones, but they kind of are in bed with everybody. And then you ask yourself, what's the alignment of interest they have? They also deal with my whole competition. But I think that's a big issue in Germany, to find trusted partners that can report or manage assets in an institutional way, but still on the ground and creative to find good deals. So.
Okay, good. I just wanted to pick up, since you're here, Markus, let's pick up on availability of finance, any particular financing trends that you're seeing, and anybody else feel free to pick that up or correct Markus if he's wrong and he's not lending you money. So what's... In terms of the last time we met, Markus, are there any kind of key changes that you're seeing?
The availability is there. There are a lot of banks competing. Also depending how much market volume there is transacted, this limits also the lending volume. I think lenders have learned their lessons past. They don't over leverage the transactions at all. That has effect on the price, and a lot of transaction we see is refinancing deals early for long term on this low level of interest at the moment. And the other part, what we at least intend to do, is focus a bit more of the sustainability of the factor, that green buildings are more in our focus, also to feed into the refinancing tool of emitting green bonds. At the moment, pricing wise, whether I have a normal mortgage bond or a green mortgage bond doesn't really make a difference. But in future, I think the normal bonds which don't have a sustainable property underneath them will trade at a premium. They need the focus of investors buying into our bonds will shift towards more sustainable product, and that's what we're preparing for. Having a plan that by the next couple of years we will have 20% of our portfolio in that region. We are one of the biggest emission houses of green fund brief, so we started this entire thing, and the industry is focusing all around that. And the other part is how do we decrease costs and become more effective digital, I think, but that is all the industry is going through. These are the trends at the moment, what we're seeing.
Okay, good.
Yeah, just quickly on that one. I agree with that, and what we see a lot with international investors or investors that hold property for a couple of years in Germany now, the last couple of months, when you meet them, they spend a lot of time actually refinancing their portfolios and not dealing on the acquisition side, but exactly for that worry that interest rate might move in a certain direction to tie that down to a degree. And the thing with Germany in general was always financing is quite binary, right? Either you get fantastic financing for the likes of Berlin Hüb, but if they don't finance your deal, it gets pretty tough because you don't get a 30 instead of a 70% leverage, you just get 0, right? So as long as you're in those core plus markets, sustainable assets, you get fantastic rates, but once you move out of that, it gets quite challenging. Yeah.
And in terms of, Christiane,
I can only confirm it from a legal perspective. So we see it increasingly in the last one to 2 years, not only in Germany but also in other jurisdictions, for example the UK, that lenders are requiring the fulfillment of green building requirements when granting a loan. And I think your role here is pretty impressive, what you're doing here. So it's very sustainable, let's say. And what I would like to point out, which is really new, and I think there's a whole community focusing on sustainability and things, and anybody really appreciates here that you're not only looking at the building certificates, which are just reviewing the building conditions at the time of erection, but you are looking at the actual performance of the property, and you look at energy consumption performance, and you do annual reviews, and you also look at the CO2 footprint there, and you do it regularly. So this is definitely something which is also being picked up by the European Commission, so there will be further standards there and regulations in this area.
Okay, good. I've got a couple of questions just come in, so thank you for those. One of which is, and I'll be interested to see what the answer to this is. So, are all the panel in agreement that we are late cycle? Everybody?
It's not early.
Yeah, that's
Definitely.
Nikolai's not nodding quite as heavily as others. Are you convinced we're late cycle, Nikolai?
It always depends.
Okay. You're hedging your bets, essentially.
I think we're approaching the end of the cycle, which is why we wouldn't buy core assets at this point at 3% yields. We buy our buildings at 6 to 8% yield still. And the second that we do, because in case of a market correction, there is not so much of a downside risk. Yes, those are obviously not all CBD properties, but still they have a good occupancies, they achieve good rents, and for that purpose also in terms of the tenant mix, they work, so why not? But then you never know, maybe this year, next year, there's definitely volatility coming to the market, which is typically a sign that there's going to be a correction. And in my view, the correction will very likely come from the US, because that's typically where it starts first, and then there's a spillover effect to Europe, and it will also come to Germany. But like I said, it's not an intrinsic problem, it's going to be from outside, but still, it will mean that opportunities will be there.
Okay, good. Interestingly, thank you, Mike, for that, which is that that Mike had heard at a recent other conference that the next global recession will not happen until 2024. So we've got to, presumably that's when Trump decides he really wants to have a third term and it's not allowed, so he goes like Erdogan does and just takes over the whole of America. That would buy into your scenario, Nikolai. Just in terms of one other question we've got in which I guess for in terms of volatility with different currencies for, you know, whether that's US, whether it's Singapore, what's happening with that? Are you is there an issue with investors in terms of stability of currency, or is everybody hedging? What's the view?
Well, I think in general, when you go to more exotic places or Asian money, etc., they look in particular for yield in Germany, right, as an example, and they want their sweet spot of like 6.5% or whatsoever, which is obviously much better than what they get at home, and that includes to a degree also a hedging component, I would say, right? If you talk to Australians, right, for them to come to Europe, the yields have to be like 3% or 2 to 3% better than what they get at home in similar markets, but that's one thing. We had the discussion before that people require a premium to move continents, but sometimes it's also just like things that happen in the world political scale that people look for diversification and know that Germany or Europe is expensive, but still want that diversification to invest in those markets.
Okay, good. Just in terms of regulation, is there anything that investors should be looking at, Christiane, that's either here or is about to happen, something that they should be thinking about?
Yeah, I think we all have heard about the recent judgment from the German Constitutional Court about that the current regulations or the approach how property taxes are being that has been
Not in line with the Constitution, right?
Yeah, it's not in line, exactly. So, and the property tax in the end is being paid by the tenants. So there will be an impact, definitely, or a new development which we need to watch. And some new valuation method has to be found until 2019. So something rather quickly has to happen there. And then I think it's not something which relates particularly or that applies particularly to the real estate industry. It's a General Data Protection Act. But this will affect basically the way we communicate all with each other. Let it be mass emails, invitations to events, newsletters, deal notifications. So this regulation will be enforced from the 25th of May. So, and basically you cannot send out any more emails or automatic emails unless you have a specific consent from the recipients. So right now at PwC, we stopped all our newsletters in Germany, and so don't be offended if you don't hear anything from us. We are currently considering to go back to hard copies.
Oh, are you?
Yeah. So and there's to send out the invitations, yes, because there are huge fines, like 20 million if you have an infringement. So this is really something.
So time to invest in forests, by the sound of it.
Probably.
Good. I mean, and that's also a very big topic for shopping centres, retail especially, because there's a huge amount of communication and data that's been gathered by modern technology coming in, use of smartphones so that you can actually judge where people are in the shopping centre, what they're doing. All of those things will become very interesting, I think, in that market. Let's just quickly look at some of the sectors. In terms of the office sector, do we see increasing rents? Do we see, because we've got a strong economy, more occupation, or are we about to hit a sort of development boom where then that there will be then more product? What's the position at the moment in terms of the office sector? If anybody wants to pick that up.
So in our view, a trend has only started a couple of years ago, maybe 2 to 3 years ago, where you see a hike in rents. If you take Berlin, for example, what we heard earlier, the top rent being beyond 30 euros a square meter. I mean, this would have been impossible a couple of years ago. But still, if you look at the average rent, then you see, that rent following also. It is because of a demand overhang. We talked about the limited supply. And then obviously German companies are doing well, and they're doing well for certain reasons. They're doing well because they are they're competitive in a global context in our view, and they will stay competitive simply because the productivity compared to the real labor cost in Germany is still very attractive, which means that the products they make can be offered globally at good prices compared to the quality they provide. And in that sense, we don't see actually from the Mittelstand, the small to mid-cap or mid-sized companies in Germany, we don't see anything changing there, and they are many times considered the backbone. And they actually occupy also the largest amount of office space in the country. And for that purpose, so it's not the law firms and the PwCs and so on, it's really those companies. And we don't see any reason why that should change.
Okay, and Thilo, you mentioned logistics. In terms of light industrial logistics, do you see that continuing to grow? Is there more of an interest in logistics rather than the light industrial side? What's your sense of it?
Where there is a big scarcity is this last mile for the retailers, and this last mile is very, very hard to deliver, because then you have to go quite near the cities, and no mayor really wants to have a shed inside the city, and no kind of neighbor wants to have the noises in the early morning and the late nights, and there's a bigger scarcity. When you have a plot there with a 24-hour use permission, that's something very valuable. We tend not to go out then with the retailers too far out of the cities. There you must have the very big distribution hubs, but not the smaller units. And in terms of light industrial, it's a very, very interesting market where you can still get the yields that you were mentioning between 6 and 9%, but there you have to have a big team, because also already with a 30 million asset, you tend to have 80 to 90 lease contracts that
management intensive,
that you have to manage, and then you have to have a big team. It's basically like you're managing a big resi block where you have all kinds of queries in that sector. So,
but it gives you good diversification.
It gives you good diversification. It gives you good return, but you have to have your game right. And since Germany, and you have all the scarcity of builders and smaller companies that are not servicing all the building sites that are not enough to service all the building sites that are happening. That's an interesting business to be the supplier of the space there, but you have to have a 30 people plus team who can handle those sectors. So we always have to look at our headcount. We are just the managers of the big sheds, and but if it was a private business, I would rather go to the light industrial, because the returns are more rewardable than going sub 5% for a shed with a long contract.
Okay, good. Karsten, in terms of the sectors, where are you seeing the demand, I suppose, from the people coming to you? Is residential now really over in terms of an investment opportunity for international investors? Do you have to look at sort of micro-living, student housing, more down that alternative route? Is it too competitive and only, it's basically all done? What's your sense of that?
Well, we don't deal with residential a lot because it's actually a no-brainer in Germany to sell it in general, but we see a few of those players that go to the more underdeveloped regions, to the Rhine-Ruhr region, where they still try to pick up portfolios for like 14, 15, 16 multiples to get a good deal out of it. If you go into the big cities, it's private individuals buying residential assets, right? And Germans have picked up what London has been doing for many years. They do go on road shows in Hong Kong, Shanghai, etc., and sell to this kind of clientele. But good probably for a private investment if you go to the big cities, because there's probably a little bit more room to grow still. But in general, it's a boring play in Germany, right? But on the other hand, the Germans have discovered residential real estate. I've been living here for 12 years in the UK, and everybody who comes out of university wants to buy the first apartment and then take equity out, buy the next bigger place. Whereas in Germany, nobody really cares, right? People rent when they're 50, and it's not part of their wealth creation strategy to own real estate in Germany, because prices have been quite flat, right? And so there's definitely a change where people in Germany saw now how you can make money with residential, and in Berlin prices have gone up over the last few years, where people now say, okay, I want to invest in real estate. But that's more on the private individual basis, and otherwise you have a lot of resi construction companies that have been very successful in the market with land banks, etc. But pure resi investment, unless you want to deal in the 2.5%, 3%, 4% universe, that probably works. But other than that, it's difficult.
And in terms of that, in terms of TH, are you moving more towards some of those alternative assets, whether that's healthcare, whether it's parking, whether it's student housing? Is that something that you're having to do in order to look for yield or look for the opportunities?
Yeah, well, this comes with our mothership, TH, because basically invest into everything that has a roof on or not has a roof on. So it could be a hospital or a senior home, land banking, and this is only the real estate part of the whole real asset group, which then is including agriculture, timber, municipality bonds. All that kind of products are done in the US, and of course we are also incentivized to sell those US products in the European and the Asian markets as a house here, and are also asked to find strategies that are long-term growable for those sectors. But the answer for that is not very quick, so I cannot tell you that we have a strategy in place for micro apartments or senior homes yet, but there are teams currently working in our product development teams to look at what sector you address. But it is likely, if you start a venture like that you go into a partnership, into a joint venture, or have some unorganic M&A action to buy an operator and to take it from there. So, and for that, of course, you have to compete for money of our general account in the US. So as we speak, we are thinking about it, but traditionally we're still in the main commercial sectors, retail, office, and logistics.
Okay, and I just wanted to bring up one kind of final thing, really, which is in Thilo's slides. You could see Berlin moving up very rapidly. What does everybody see about that? You've got investors pouring in at the moment. It's in terms of density, actually, it's the area the size of London, but much less dense. Is there a potential for, or a desire in Germany even, for Berlin to become closer to London and actually to be the leading city as opposed to everything being equal. So is that something that there's potential for? Is it something that might happen? Can that growth for Berlin continue? And anyone can pick that up, whether it has an airport or not, Markus.
Well, it actually has two, which are very well functioning and everybody likes. The new one is not really, people are not really keen on that. But yeah, Berlin, the size of London, half of the surface is forest or water. Yeah, that is very green out there. Is there potential to grow? Yeah, there's a trend, an urbanization trend. People move towards the city. And where is the demand for the office coming from? What we see also recently is that companies who have their headquarters outside are moving their R&D departments into Berlin because they have the talents there. So they have students, they have the startups, they have the fintechs, everything is happening there, and that's why they say people don't want to move to Rüsselsheim or to Erlangen or wherever Bochum, where the cars are manufactured, but they want to be in that hip environment where they are. So the company is moving towards where the talent is, and that's driving the demand in Berlin, and that's driving also people coming there. So that's the story at the moment. That's why the demand and why the prices are picking up. Besides the general urbanization trend in Germany, and there are regions where we can lose money in residential easily because it's depopulated. It's people don't believe they're only the old people living there, and that's is a problem in some of the areas. So it's not everywhere a success story. But if you look for growing cities with universities with talent, that's definitely something where this trend will continue, and where also this demand will continue.
Yeah, I think the point why Berlin is the way it is at the moment is because they don't want to be like London, right? People want to go to Berlin because it's actually different from London, or it's more like a Shoreditch kind of thing. So once Berlin moves in that direction, probably people go back to London because at least you understand the language they speak, right? And so it's affordable at the moment still, right? Although prices have gone up quite a bit, and it's a young audience, and that's what it caters to. So I think it will always be, their success story is always based on being different to those kind of cities. So once they become a Paris, London, etc., I think then it gets difficult. Yeah.
And the German system does not cater for that. I mean, you have the harbor there in Hamburg, you have the Rhine-Main area, we have the Bundesbank sitting there, you have the financial area, you have Munich as a strong city with all kind of research, with all kind of Siemens, is that whoever main company is sitting there, they will not just give up their area there. So that there's always some cities competing. So Berlin will never have the same status as a London or Paris for the country because the entire setup is not made for that.
Excellent. Right, last question. Our usual one about where people should invest so that they can have a takeaway from it. So let's see, Markus, let's start with you. Where would you, and you can invest your own money should you wish, but where do you think the opportunities are at the moment? Where would you lend on, in essence?
No, I'm very happy that I bought my house 6 years ago and not now. But I agree with Thilo, the kind of last mile logistics, with the need, with all the electronic or all the online trade, that's something where really is a need, there's a scarcity, and that's why you can easily get good returns there. Okay, all right, good. Christiane?
Yeah, I can only agree with that. But in addition, we have seen several healthcare transactions, and particularly nursing home transactions going on in the last 1 or 2 years. And see, it is, from a legal perspective, very interesting transactions. But when you look a bit closer, particularly at the nursing homes, the quality of some properties leaves some room for improvement. So what I would wish for and I would invest in is like if the green building requirement standards are being implemented into these asset classes as well.
Okay, good. Nikolai?
I would say office properties. Although I wouldn't go into core properties, I would stay away from core properties simply because the prices are now really too high. But if you went into buildings that you could acquire below replacement cost, then it may totally make sense. And then still obviously deals that provide for cash flow. And then secondly, I would say everything that has to do with healthcare, not necessarily only medical centers, but also maybe senior housing, those kind of things, where you might need an operator. We are not an operator for healthcare in that sense, but there's others in the market who have an edge, and I think can provide good value.
Okay, good. And is that based on sort of aging population in Germany, those kinds of more demographic things, or simply that you see that as an opportunity?
There's definitely a demographic component to it, but then also if you take the disposable income of households, then you see that basically, people can afford moving their parents, for example, to senior housing now rather than they could 10, 20 years ago. So for that reason, there's obviously increasing demand.
Okay, good. Thilo?
Yeah, from a personal point of view, it's quite interesting sector is there are two kind of data crossing points in Frankfurt where the big data pipes are running. One is on Hanauer Landstraße and the other one is in the very west of Frankfurt called Griesheim, a very ugly suburb, but there those data companies are buying up every piece of land that they can get for record pricing. So I would be targeting there from a private point of view, because it's a kind of an interesting niche where you could invest. And from a corporate level, we try to educate our really core investors to go away from this mono-sector investment into either retail or logistics or office to a kind of we call it Quartiersentwicklung, so a whole quarter with different uses. So micro apartments, hotels, offices, but in a flexible way, so kind of a desk sharing way, retail, restaurants in the whole one block, and that in a great location in Frankfurt, Stuttgart, Berlin or Hamburg. But of course there you need a big institutional money, because to do that the right way you must have at least an investment volume of 200 million euro plus, and there if you want to do it as a fund you have to have a billion plus fund to have a diversification. But this is kind of, I think, the model for the future, where you have the different users that are benefiting from each other, and that done in a smart way. I think that's the future of big institutional real estate.
Okay, good. Karsten?
Yeah, probably two things. One is, again, that urban logistics, maybe light industrial scheme to a degree, where you have to get your hands dirty, but you get good returns out of it, because there are almost no vacancies in those areas, but it's hard work. And the other thing, I would look at good university cities in Germany. I mean, we had the discussion the other day where patents issued in Europe, I think 40% come out of Germany. It's 3% of GDP in Germany, and when we sold assets in some of those unconventional towns, we were quite surprised what kind of companies come out of those universities and then settle in the area there to attract students, etc. So to cater to that degree, maybe a co-working space scheme which caters to those university B cities more than like the WeWorks in the big cities could be also an attractive alternative. Yeah.
Okay, good. But thank you very much for joining us. And if you could join me in thanking yourselves and the panel, that would be great. Thank you.